A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
You know, Corn, I was looking out over the old city this morning, just watching the light hit the stone, and I was thinking about how some things here have stood for thousands of years because they were built for permanence. They were built with a certain kind of integrity that does not care about the shifting winds of politics or the latest linguistic trends in a corporate boardroom. There is a weight to these stones, a sense that they do not need to explain themselves to a committee. They simply are.
Herman Poppleberry at your service, and I think I know exactly where you are going with that. You are contrasting the literal bedrock of Jerusalem with the shifting sands of the global capital markets. It is a sharp turn, but a necessary one, because our housemate Daniel dropped a folder on the table this morning that really highlights how quickly the permanent values of the financial world can evaporate when the temperature gets a little high. We are seeing a massive linguistic migration right now, moving away from the lofty heights of moral purpose and down into the trenches of risk management.
We received a fantastic, albeit challenging, letter from a listener named Hilda in London. And Hilda, if you are listening, thank you for this. You have really put your finger on a pulse that a lot of people in the impact investing world are trying to pretend is not racing. She is looking at the way the industry is rebranding itself right now, specifically here in March of 2026. She sees the acronyms that define the last decade, environmental, social, and governance, or ESG, being scrubbed from websites and replaced with a single, much more sterile word, resilience.
It is the great resilience pivot. That is the buzzword of the year. We have seen ESG become an absolute lightning rod in the United States. Between the second Trump administration's focus on strictly enforcing fiduciary duty and the broader pushback against what many call woke capital, the old terminology has become radioactive in certain circles. The Department of Labor has been very aggressive over the last 14 months, basically telling fund managers that if they cannot prove a direct, quantifiable financial link for every social metric they track, they are in breach of their duty to retirees. So the industry is doing what the industry does best. It is changing its clothes. It is trading the activist megaphone for the actuary's spreadsheet.
Right, and Hilda's challenge to us is essentially a question of soul. She asks about the sincerity gap. If these people were truly founded on the idealistic vision of doing good and doing well, why are they scrambling to hide behind the word resilience the moment the political winds change? Is this a strategic evolution, as some claim, or is it just a surrender of core values to stay in the room with the big money? She is asking if the movement ever actually believed its own press releases, or if it was just waiting for a reason to stop pretending it cared about anything other than the bottom line.
I have a very strong feeling about this one, Herman. I think Hilda is right to be skeptical. To me, this looks like a movement that found its moral compass was standing in the way of its management fees. When the political cost of being a hero became too high, they decided to just be consultants instead. But I know you've been reading those new Securities and Exchange Commission guidelines from the first quarter of this year, the ones that just dropped in January, so maybe you see it differently.
I do see it differently, Corn, and I think we are going to have a real disagreement here. I do not think resilience is a retreat. I think it is the arrival of maturity. It is the moment where we stop talking in poetic aspirations and start talking in the language of the machine, which is the only way to actually move the trillions of dollars we need to move. If we want to solve climate change or social instability, we cannot rely on the kindness of billionaires. We have to make it a mathematical necessity. But before we dive into the math, we should probably frame the stakes for Hilda.
The stakes are enormous. We're talking about an impact investing market that reached $1.16 trillion in 2025, according to the Global Impact Investing Network. That is a massive amount of capital that is supposedly dedicated to making the world better. But if that capital only does good when it can be framed as a risk mitigation strategy to satisfy a regulator or a skeptical administration, then did the good ever really matter in the first place? If the morality is just a byproduct of a hedge, is it still morality?
See, that is where you and Hilda are starting from a place of moral suspicion. I want to start from a place of functional reality. Let's look at why this is happening. The Trump administration has been very clear. If you are a fund manager, your primary, and arguably only, duty is to the financial return of your beneficiaries. If you are seen to be sacrificing returns for social engineering, you are looking at massive litigation risk. We are seeing class action lawsuits popping up in Texas and Florida against pension funds that are accused of prioritizing climate goals over quarterly dividends. So, the industry has had to ask itself, is doing good actually a financial necessity? If it is, then we should be able to prove it without using the word justice.
And their answer is, let's call it resilience so we don't get sued. That is not a moral discovery, Herman. That is a legal defensive crouch. Hilda points out that this rebranding suggests the original integrity was shallow. If you truly believe that treating workers well or protecting the environment is a moral imperative, you do not stop saying it just because it is unpopular in Washington. You stand by it. You make the case for why it is right. By switching to resilience, you are admitting that you are only doing these things because you are afraid of what happens if you do not. You are moving from a logic of aspiration to a logic of fear.
But Korn, you are ignoring the technical shift. This isn't just a name change. We are moving from impact first bonds, which we talked about way back in 2024, to these new resilience linked notes. The difference isn't just the word on the cover. The difference is the underlying math. A social impact score was always a bit fuzzy, right? It was hard to quantify exactly how much value a diverse board or a community garden added to a company's stock price. But operational resilience? That is something an actuary can get behind. It is about the probability of a supply chain disruption. It is about the cost of labor turnover. It is about the physical risk to assets from extreme weather. This is a much more robust way to account for the world.
Oh, I see. So we are going to turn human dignity into a probability curve. That leads right into Hilda's second point, which is the philosophical critique. Is it moral to frame the treatment of human beings through the logic of a risk mitigation calculus? When we say we should treat our factory workers better not because they are human beings with rights, but because a strike would be a risk to our supply chain resilience, we are losing something fundamental. We are treating people as variables in a hedge. We are saying their value is entirely derivative of their potential to cause a problem for the shareholders.
But isn't that how a market works? If you want a pension fund in Ohio or a sovereign wealth fund here in the Middle East to move $10 billion into a project, you cannot lead with this will make people feel good. You have to lead with this project is less likely to collapse in 10 years because it accounts for social stability. That is what resilience means. It means the ability to withstand shocks. If a company is impactful but fragile, it fails, and the good it was doing disappears anyway. I would argue that the old ESG model was actually more dangerous because it encouraged companies to do things for PR reasons that weren't actually sustainable for their business model. Resilience forces them to integrate these factors into their core strategy.
That sounds like a very convenient justification for cowardice, Herman. We covered something similar in episode 1353, where we looked at the impact paradox. The idea was that solving problems sometimes kills profits. What I see happening now with this resilience rebrand is the industry trying to pretend that paradox doesn't exist. They are saying, don't worry, we aren't doing charity, we are just being really, really smart about risk. But if the risk model changes tomorrow, if it suddenly becomes resilient to exploit people, because the regulatory environment shifts back, or because a new technology makes human labor obsolete, what happens to the impact? If the only reason you are being good was to avoid risk, and the risk goes away, then the goodness goes away too.
That is a fair question, but look at the actual data. The Securities and Exchange Commission's first quarter guidance for 2026 on the materiality of externalities is a game changer. It effectively forces firms to categorize social issues as financial risks. If you do not account for the resilience of your labor force, you are now potentially liable for misleading investors about your long-term stability. This isn't a retreat from impact. It's the codification of impact into the very bedrock of fiduciary duty. It is moving impact from the marketing department to the risk committee. And in the world of finance, the risk committee has all the power.
It's the dehumanization of impact, Herman. That was Hilda's third point. She called it a dehumanizing form of technocracy, and I have to agree with her. When we stop talking about the S in ESG as social responsibility and start talking about it as human capital resilience, we are stripping the humanity out of the system. We are saying that the person working the line or the community living near the mine only matters insofar as they represent a potential disruption event on a spreadsheet. We are building a world where we only care about the forest because it prevents a flood that would damage our warehouse. We don't care about the forest because it is a forest.
But Corn, look at the result. If a company invests in clean water for a community because they want to avoid a disruption event, the community still gets clean water. Does it matter to the mother whose child isn't getting sick whether the CEO did it out of the goodness of his heart or because his chief risk officer told him it would protect the company's 20-year valuation? The water is still clean. The outcome is the same. In fact, the outcome is more secure under the resilience model because it is tied to the company's survival, not just its philanthropy budget. Philanthropy gets cut during a recession. Risk mitigation gets funded because it is a necessity.
I disagree that the outcome is the same in the long run. The why matters because the why determines what happens when the math changes. If you do it because it is right, you keep doing it when it is hard. If you do it because it is a risk mitigation strategy, you stop doing it the moment you find a cheaper way to mitigate that risk. Maybe you don't need clean water for the community if you can just hire a private security firm to keep the protesters away for less money. That is resilient too, isn't it? It protects the asset. It ensures the mine keeps running. If your only objective function is the survival of the corporation, then oppression can be a very efficient form of resilience.
That is a dark way of looking at it, but let's look at the actual instruments being issued right now. D's resilience. Link notes often have step-up interest rates. Let's say a major apparel company issues a $500 million note. If that company fails to meet its targets for worker safety or carbon reduction, the interest they pay to their investors goes up by 50 basis points. That is a hard financial incentive. It's not about feeling good, it's about the cost of capital. I would argue that this is actually more sincere than the old way because it puts a literal price on failure. It creates a market where investors are actually betting on the company's ability to be a good actor.
But it puts a price on failure to the investor, not to the victim. The investor gets paid more if the company fails to be resilient. There is a perverse incentive baked right in there. We talked about this in episode 439, looking at the old rules of impact investing. Back then, it was about blacklisting bad actors. Now, we are basically saying we will bet on your failure to be good, and if you fail, we make a higher yield. How is that a moral evolution? Hilda is right to call this out as a sincerity gap. It's a shell game where the house always wins, and the people on the ground are just the data points that trigger the interest rate hike.
It's not a shell game, it's a hedge. And hedges are how the world stays stable. Corn, you are being an idealist, which I respect, but you are ignoring how power works in 2026. We are in an era where the American government is deeply skeptical of any policy being enacted through the back door of the financial system. If impact investing wants to survive, and more importantly, if it wants to keep growing, it has to speak the language of the Trump administration's Department of Labor. It has to prove it is about protecting the retirement savings of the American worker, not about pushing a social agenda. If we can prove that climate change is a threat to a teacher's pension, then we can act on it. If we just say it's the right thing to do, we get blocked by a court order.
But that is exactly what Hilda is saying. If the movement was founded on a vision, and it abandons that vision the moment a skeptical administration comes into power, then the vision was never the foundation. It was just the marketing. It makes the whole thing look like wokewashing that has now been scrubbed clean into resilience. Washing. It's the same people, the same funds, the same high management fees, just with a new coat of paint to avoid a subpoena from a congressional committee. It feels like a betrayal of the people who actually believed this was about changing the world.
Let's pull back for a second and look at the sincerity gap Hilda mentioned. Hilda, I think you are right that there is a gap, but I think the gap is between what the marketing department said in 2020 and what the actual analysts were doing. The analysts were always looking at risk. They were always looking at how climate change or social unrest would affect the bottom line. The idealism was the coat of paint. What we are seeing now is the paint being stripped away to reveal the actual machinery, and I would argue the machinery is actually more honest. It is cold, yes. It is clinical, yes. But it is the truth of how capital moves.
More honest, perhaps, but more hollow. If we admit that the idealism was just a coat of paint, then we are admitting that the critics were right all along. We are admitting that impact investing was never about changing the world. It was just about finding new ways to price externalities that the market had previously ignored. If you tell a young person today, go into impact investing so you can help mitigate probabilistic disruption events for multinational corporations, do you think you'll get the same level of talent and passion as when you said go into impact investing to change the world? You are trading the fire of conviction for the cold comfort of a risk model.
Maybe not the same passion, but maybe more competence. We need people who can build complex climate-adjusted asset pricing models, not just people who can write a stirring mission statement. Look at the shift in the labor market. The people getting hired in this field now aren't coming out of nonprofit management programs, they're coming out of actuarial science and data engineering. They are building the resilience frameworks that the SEC is now looking for. This is the professionalization of the movement. It is the transition from a cause to a discipline.
And that brings us back to the dehumanization argument. If the framework is built by actuaries, the human being at the end of the chain becomes a data point. Hilda's concern is that this technocratic approach fails to see the humanity in the systems it claims to fix. And she is right. If you treat a community as a risk factor, you are inherently placing yourself in an adversarial relationship with them. You are managing them, not partnering with them. You are mitigating them. It creates a distance between the investor and the impact that makes it very easy to make decisions that are technically resilient but morally bankrupt.
But isn't mitigating a problem better than ignoring it? For decades, the dehumanization was even worse because the people weren't even on the spreadsheet. They were externalities, which is a fancy economic word for things we don't care about. Now, under the resilience model, they are material. They have to be accounted for. That is a massive step forward for humanity, even if the language used to describe it is cold and clinical. We have finally forced the market to admit that the world exists. That is a victory, Corn, even if it doesn't feel like a romantic one.
I see your point, Herman, but I think you're being too optimistic about the materiality part. If I am a chief executive officer and I see that social risk is material, my first instinct might not be to improve the lives of my workers. It might be to automate their jobs away so they aren't a risk anymore. If I replace 1,000 risky human beings with 100 resilient robots, my resilience score goes through the roof. My impact, however, is a disaster for that community. That is the danger of this rebrand. It rewards the removal of the human element in the name of stability. We are incentivizing companies to decouple themselves from society to avoid the risks that society presents.
Wow. That is a powerful point, Corn, and it actually reflects some of the tensions we are seeing in the resilience linked note market right now. There is a debate about whether labor force reduction should count as a resilience gain. Some frameworks say yes, because it reduces strike risk and healthcare costs. Others say no, because it creates long-term social instability in the region where the company operates, which eventually comes back to haunt them. This is exactly where the sincerity gap gets tested. Are we measuring the resilience of the company in a vacuum, or the resilience of the system the company relies on?
And if the movement was truly about doing good, the answer would be obvious. You would focus on the system. But if it's about risk mitigation for the shareholder, then the robot option looks pretty good on a 10-year horizon. This is why Hilda's critique is so vital. She is forcing us to ask, what is the objective function of this entire industry? Is it the flourishing of sentient beings, or is it the survival of the corporation? Because in 2026, those two things are increasingly at odds.
Well, let's look at the objective function from the perspective of an institutional investor. Say, a large pension fund for firefighters. They have a fiduciary duty to make sure that money is there for those firefighters in 30 years. For them, flourishing of sentient beings is a nice to have, but survival of the corporation is a must have, because that is where the returns come from. If resilience is the bridge that allows them to invest in things that also happen to be good for the world, Isn't that a bridge worth crossing? Even if the bridge is made of cold steel instead of warm intentions?
Not if the bridge leads to a world where we've traded our values for a slightly more stable discount rate. Hilda's letter really struck a chord with me because it feels like we are at a crossroads. We can either admit the capital markets are fundamentally incapable of doing good on their own and require a strong moral and regulatory framework that isn't afraid to use words like justice and rights, or we can keep playing this game of linguistic hide-and-seek where we call justice resilience and hope the politicians don't notice. But the politicians do notice. That is why we are in this mess.
I think you are being too hard on the linguistic hide-and-seek corn. In a pluralistic society, and especially in a hyperpolarized one like the United States in 2026, shared language is hard to find. Resilience is a word that both a conservative hedge fund manager and a progressive environmentalist can agree on, even if they mean slightly different things. The hedge fund manager wants to protect the asset, the environmentalist wants to protect the ecosystem. If the word resilience allows them to work together to keep a forest from being clear-cut, why should we care if their sincerity doesn't match? The forest doesn't care about their motives.
Because the environmentalist will stop when the forest is safe, and the hedge fund manager will stop when the forest is no longer a material risk. If a new technology comes along that makes the company resilient to the loss of that forest, say a synthetic replacement for the timber, the hedge fund manager will sign the order to cut it down without a second thought. That is why the why matters, Herman. Integrity isn't just a luxury, it's the only thing that prevents the risk mitigation logic from turning predatory. Without a moral anchor, resilience is just a more efficient way to exploit the world.
That is a fair critique, and it leads us to a really interesting place for our listeners, especially those who are trying to navigate their own portfolios in this new environment. If you see resilience in a company report, how do you know if it's resilience? Plus, meaning it's actually tied to social outcomes or just resilience, washing.
That is the million-dollar question, or the $1.16 trillion question. I think the first takeaway for our listeners has to be, audit the data models, not the mission statements. If a company claims it is focusing on resilience, look at what they are actually measuring. Are they measuring the well-being of their employees, or are they measuring turnover risk? Are they measuring the health of the local watershed, or are they measuring their own water access security? Those are two very different things, even if they both fall under the resilience umbrella. You have to look at the key performance indicators, or KPIs, that are actually tied to the financial instruments.
Right. And for the individual investor, I think the advice is to look for resilience plus frameworks. These are the ones that explicitly tie their risk mitigation to measurable, positive social externalities. There are funds out there that are doing this well. They are using the new SEC guidance to be more transparent about their impact, not less. They are saying, we are being resilient by being impactful. They are proving that a healthy community is the only true hedge against social unrest. You want to look for funds that have a clear theory of change that links the financial risk to the social reality.
I would add a second takeaway. Do not mistake a company's resilience report for a moral commitment. Treat it like what it is, a disclosure of financial strategy. If you want to do good with your money, you might need to look beyond the large institutional resilience funds and look at smaller, impact-first vehicles that haven't traded their sincerity for political palatability. They might have a higher risk profile, and they might be under more regulatory pressure right now, but at least you know what they stand for. Don't let the big banks convince you that risk management is the same thing as social change.
And finally, I think we have to address Hilda's point about dehumanization directly. If you are an investor or if you work in one of these firms, you have to be the one to put the human back in. Data models are tools, not masters. If the model says it's resilient to do something that you know is morally wrong, the model is incomplete. It's failing to account for the moral risk, which is a very real thing, even if it's hard to put in a spreadsheet. We saw this with the backlash against certain tech companies in 2025. They thought they were being resilient by cutting costs, but they destroyed their brand equity in the process.
Moral risk. I like that, Herman. Maybe that's the next rebrand, although I doubt the current administration would be any more fond of that term than they are of ESG. But you're right. There is a reputational and spiritual cost to these things that the current resilience metrics just do not capture. If you lose your soul to save your spreadsheet, you haven't really won anything.
So, did we answer Hilda? I think we've shown that her skepticism is well-founded. There is a sincerity gap, and it is wide. But I still maintain that this resilience pivot is a necessary, and perhaps even positive, step toward a more realistic and sustainable form of impact. It's the growing pains of an industry trying to survive in a world that is increasingly hostile to its original vocabulary. We are moving from the age of innocence to the age of experience.
And I still maintain that it's a dangerous slide toward a cold, technocratic future where we've forgotten why we wanted to do good in the first place. If the only way to get capital to do good is to trick it into thinking it's just mitigating risk, then I think we've already lost the battle for the soul of the market. We are teaching the market how to be a better predator, not how to be a better neighbor. But I suppose that is the debate that will define the next decade of finance.
It certainly will. And Hilda, thank you again for the prompt. It's these kinds of questions that keep us, and hopefully our listeners, from getting too comfortable with the easy answers. We need the skeptics as much as we need the actuaries.
And if you are out there listening and you have your own challenges to the way the world is changing, or if you just want to weigh in on whether I'm being too cynical or Herman is being too pragmatic, we want to hear from you. Head over to myweirdprompts.com. There is a contact form right there on the site. You can also find our full archive and all the ways to subscribe, including the RSS feed, if you want to keep us in your favorite podcast app.
And if you're on Telegram, just search for My Weird Prompts. We have a channel there where we post every time a new episode drops. It's a great way to stay connected and join the conversation. We really value the community that's built up around these discussions over the last 1,300 plus episodes. It is the listeners like Hilda who keep us sharp.
We really do. And hey, if you've been enjoying the show, a quick rating or review on Spotify or wherever you listen would be a huge help. It genuinely makes a difference in helping other people find these deep dives. We are trying to build something that lasts, much like those stones Herman was talking about.
It really does. Well, Corn, I think I'm going to go back to looking at those Jerusalem stones. They have seen empires rise and fall, they have seen trade routes open and close, and they have never once felt the need to rebrand themselves as resilient. They just are. There is a lesson in that, I think.
Must be nice to be a rock, Herman. No fiduciary duty to worry about. No SEC filings. No political headwinds. Just sitting in the sun.
None at all. This has been My Weird Prompts. Thanks for listening, everyone. We will be back soon with another prompt from Daniel, and hopefully another great question from one of you.
Until next time, keep asking the weird questions, even the ones that make the fund managers nervous.
Take care, everyone.
Peace.
Wait, Corn, I just thought of one more thing regarding the SEC guidance. Do you think the emphasis on materiality might actually backfire if a company can prove that their social impact is not material to their bottom line?
That is exactly the fiduciary duty trap I was talking about. If you can't prove it's material, then under the current rules you might actually be forbidden from doing it. You could be sued by your own shareholders for being too kind. It's a double-edged sword, Herman. We are creating a system where goodness is only legal if it is profitable.
Wow. Yeah, we might need a whole other episode just for that. The legality of kindness.
Episode 1339?
Maybe. Let's see what Daniel sends us.
Fair enough. Goodbye for real this time.
Bye, everyone.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My Weird Prompts, that's the close from sloth, from man, from long-eared host. My Weird Prompts, until next time, stay curious, keep weirding.